Hi guys, it's SJ speaking, and in today's video, we're going to see about share buybacks. Stock splits, reverse splits, dividends, share bonus issue, and these are all part of corporate actions, and share buybacks is also one of them. Before going to the video, if you want to join my trading course, you can contact me from the number in the scrolling below, and I'll give you the details, and I'm also providing discounts for the first 25 members. So, if you are interested, you can join my course. So, now let's go into the video. So, what are share buybacks? So the company normally issues share to the public and raises capital if it wants money. So it funds it by issuing shares to the public. So this is the IPO process. So the company does not take part in the secondary market. In the secondary market, that is the exchanges, we normally buy in shares, sell shares among ourselves. The investors do the transactions among themselves. The company has no part of it. But sometimes the company decides to buy back shares from the investors in the secondary market by either directly by open offers, that is the open market offer, or by issuing tender offers. So this is what buyback is. So buybacks are also known as share repurchase. So a share buyback is when the company uses share to buy its own shares from the investors. The company either uses the cash which is excess, so which is accumulated, or it can use the cash flow which is from the day-to-day business operations, which is known as cash flow from operations, or it can use taking cash by taking debt from others, from any creditors. It can take debt and it can buy back the shares. But if it uses the debt money to buy back the share, there you have to take note of it. There is something wrong with the company, whether the company might be in a financial stress or something. So you have to look into the other factors too. So the company usually offers buyback at a higher price compared to the current market price. Suppose if the current market price is 150, it might offer buybacks at 250. So this is how the investors are attracted, and the share price will increase from the 150 rupees once the buyback is issued. So usually offers buybacks at a higher price. So after these buybacks, these shares which are bought back are usually destroyed, that is extinguished or retired. But they can also be reissued later after some few months or years, or they can be given to the employees of the company. You might have heard of employee stock options, such as that it can be given to the employees in the form of compensation. So, what are the reasons for buybacks? Usually the buybacks happen if the company's promoters have high confidence in the company's growth. So, the company's owners and the main partners who have been at the start of the company, when the company started, they had been from the start, who have invested in the company. Those promoters, if they have high confidence in the company's growth, they might do buybacks. Or if they wanted to increase their stake in the company, the company's promoters want to increase the stake in the company, and in order to avoid the takeovers from the other company members, other company CEO, usually those who have higher stake, they can take control of that company. So in order to avoid others from taking over, because the other members, if they are interested in your company, they might start accumulating your company's shares. They might start buying the shares from the other shareholders, and they might try to increase the stakeholder, and they might try to take over your company. So in order to avoid this takeovers, the company's own promoters might try to increase their stake. So they start buying back the shares from the other investors and other shareholders. Then the other thing is that in order to stop the share price from falling down, for example, if the share price is 250 and it did, suddenly fall to around 150, in order to prevent the share from falling further, they might issue the buyback. They might announce buyback at 200 rupees. So what the investors that they try to avoid selling the stock at 150, and they try to sell the stock at 200 rupees. So after the buyback, the stock stops decreasing, and it might increase. So this is how they do prevent the stock price from falling down by issuing buybacks. And the next thing is that the buybacks increase the profitability on a per share basis. Once the buyback occurs, the number of outstanding shares decreases. Once the number of outstanding shares decreases, the EPS automatically increases. That is the earnings per shares. Since earnings per shares formula is net income by number of shares outstanding. So once the EPS increases, the PE ratio decreases. So if someone analyzes the company, the new investors who want to invest in the stock, they might find the financials attractive because EPS is the main factor. This is the first thing that you have to look into when you're analyzing the company. The EPS is the first thing that you have to look into. And so this is one factor. But the companies, in order to, if the company is in a bad position and if it wants to artificially increase the financials in order to make the financial attractive, the company buyback and they can increase the EPS artificially, and the company can do this buybacks for manipulation also. So you have to look into the other factors to see whether the company is actually good. So you have to look into the other factors, because the EPS must increase only if the net profit, net income increases. So other than that, if the EPS increase, there is something other factors such as buybacks or some other stuff, and the EPS is artificially being increased. So you have to look into these things. Though the buybacks can also be used for manipulations by the company. So the next thing, in order to give value and reward the shareholders, so the company can issue buybacks. So because when the company issues buybacks, usually you are selling the stocks at the, if you are participating in the buyback process, you are selling at a higher price and it gives profit for you. So in order to reward the shareholders, the company does this. And there are two ways of participating in share buybacks. One is open market offer and another is tender offer. In open market offer, the company buys the shares directly from the sellers in the open market, that is the exchanges. So in the share market, the company directly buys. So when the buyback is announced, the company also mentions the buyback period, the price per share also is fixed, and the total cost is also fixed. That is, the company announced the maximum price up to which the company will buy the shares directly from the open market. That is, in the more open market offer, what happens is that the company starts buying shares directly from the sellers at the current market price. And if the current market price is 150 and the company issues a, sorry, fixes a maximum price. So suppose if the maximum price is 250, till the 150, till when the price comes till 250, it will buy. But over above 250, the company stops buying. And once the buyback is complete, the company usually closes. Below 250, the company buys. So once the company buys all the number of shares it needed to buy from the open market, then the buyback is closed. So the you might have a doubt whether if the company announces a buyback at 250, maximum price 250, and if the current market price is 150, whether I have to put the limit order at 250. So this is not the case. The company usually buys the price at the current market price, but up to 250 it can buy. So usually the investors prefer this tender offer more than this buy offer, because the tender offer is a buyback process where the shareholders can sell their shares at the price set by the company. So usually shareholders prefer this buyback process. So usually they are not attractive in this open market offer. So, but once the buyback is announced, the share price would increase. So if the current market price is 150, it can increase. So this is the information effect. So in the tender offer process, you can sell the shares at the price set by the company. So a company fixes a record date when usually it checks the registers for the shareholders who are eligible for the buyback process. So any kind of corporate action such as dividends, stock splits, or bonus, there is a record date, there is a X date, and you have to buy 2 days before the record date for to be eligible, or you can say 1 day before the X date to be eligible for the corporate action, whether the dividends or buybacks or stock splits or any other stuffs. So if there is a holiday, then if the record date is in a holiday, then you have to take the previous day as the record date, and the previous day before acts the X date, and before the X date you have to be bought the share, you have to buy the shares to be become eligible for the buyback. Then after the record date, the company sends a letter of offer to all the shareholders of the company who are eligible for the buyback. You have to read the letter of offer carefully. So in the letter of offer, the buyback ratio is given. Usually the buyback is given in the ratio term in the process of ratios, and there are two categories. Suppose on the record date, the closing price is 150. So if the holding value is less than 2 lakhs, suppose if you are having 100 shares, the current market price on the closing price on the record date 150, your total value is 1 lakh 50,000. So or you are on the reserved category. That is for small shareholders. You are considered as a small shareholder. But if you are having 200 shares, your total value is 3 lakhs. You are having more than 2 lakhs, then you are in the general category for all other eligible shareholders category. So take this example. So this is just an example. So if you are having 7 equity shares, you are eligible. One share can be buyback from you if you are having 7 shares. In this general category, 108 shares if you have, you can 1 equity shares can be taken from you for the buyback. So so in this example, suppose if you are having 28 shares, 7 into 4, 28. For 4 equity shares are guaranteed to be brought back from you in the buyback process. But you can tender all these 28 shares, or you can simply tender the 4 shares, but you are eligible for tendering all these 28 shares. But there is no guarantee that all the 28 shares will be brought back from you. If the participation is less, if the participation is high, there is less tendency, less probability. But if the participation is less, then all the 28 shares can be brought back from you. And in the second scenario, you can also even tender all the, if you have 216 shares, then 2 shares are eligible in this second process, but you can tender all these shares. But if the participation is less, these all shares can be even brought back from you, but there is chances are less. So acceptance ratio means the number of shares which are brought compared to the shares which you are tendering. Based so if you are tendering around 4 shares, and if all the 4 shares are accepted, then your acceptance ratio is 100%. If only 2 shares are accepted, then the acceptance ratio is 50%. So based upon this participation, your acceptance ratio might increase or decrease. So this is the thing. And uh, this tender process, usually you can go in Zerodha. For example, if you're using Zerodha, you can use it the buybacks. You can go to dashboards and you can check the portfolio, corporate actions, buybacks, and you can tender your shares for the selling. And once you tender these shares, these you can't sell you must not sell these shares. Okay, this is one thing. And after this buyback, the payment gets credited directly to your bank account. So not your your unexpected. So once the shares are tendered, your unaccepted shares will be returned to your demat account after some days. And after this buyback happens, the amount will gets credited directly to your bank account, not your trading account, but your bank account through the Clearing Corporation of India. So this is what the buyback process is. So hope you guys enjoyed this video. So give a thumbs up if you like the video, share it with your friends and family, subscribe to my channel, press the bell icon and comment on my video and press the all button so you get notified for my videos. If you want to open a Demat account, you can visit the Zerodha link on the video description and you can open a Demat account online. And if you want to learn trading from me, you can contact me from the number before. I'm also providing discount for the first 25 members. So thank you guys. So hope you guys enjoyed this video. I will visit you on my next video. Until then, bye bye. Take care.